Let me ask you a different question, which is, we talked a little bit when I saw you last week about the markets.
Yeah.
Jamie Dimon was here yesterday, and he was not pessimistic, but he was, as he would say, cautiously pessimistic insofar as he believes that stuff is relatively priced for perfection right now. Does that feel right to you?
So I'm cautiously optimistic.
Okay.
That being said, I have scenarios where it could be pretty bad. I believe if we could unlock all this private capital, we're going to have enormous growth. At the same time, some of this is going to create new inflationary pressures.
Right.
And I do believe that's probably the risk that is not factored into the markets. I think the bond market is going to tell us where we're going. And I've been saying now for some time, I may have said it last week, there's a probability we could see the 10-year over 5%, maybe even 5.5%. That would shock the equity market. That would not be a good scenario.
And do you think that would be a temporary scenario insofar as the bond market says effectively to the U.S. government, we're not doing it this way, folks. And then you'd see
a pivot.
Trump administration pivot, and then the equity market would shift again?
I think it would start would start a conversation that we need in our country, and that is, how are we going to bring down our deficits? The positive side of what the Trump administration is doing, they are trying to find growth from the private sector.
Right.
So depending on how that all plays out and how quickly the private sector can effectively put capital in the ground and start building, that's one side. At the other side of it, there are some very large inflationary pressures that we all have to be aware of. And depending on how this plays out, there is a scenario where we're going to have much more elevated interest rates because of inflation. And that's going to have a very negative impact on the equity market. It's going to change, it's going to force a revaluation, but it will probably create a real conversation. What are we going to do about the deficits?
Becky's got a question back in New York. Becky?
Hi, Becky. Happy New Year.
Hey, Larry. Happy New Year. Good to see you.
Good to see you.
I'd like to hear a little bit more about this. That's not your base case, I assume, this higher inflationary situation and higher interest rates. What do you think the Fed does? First of all, how likely of a scenario is it that we see that higher inflationary issues? And second of all, what do you think the Fed does? Because we've got another FOMC meeting next week. You think they're going to be sidelined for a while, just waiting to see what the impact of the new administration's policies are? Or how do you kind of figure this out from the market perspective?
Well, I don't think the Federal Reserve spends any time focusing on what policy issues are going to be affecting the future. I think they're going to be focusing on the data at the moment. And the data at the moment is fine. Whether they're going to ease one more time or pause, I do not see any scenario in the short run that the Federal Reserve is going to reverse course. And my base case scenario is we're going to have rates staying stickier. And what I mean by that is we're going to have probably a more normalized yield curve. The yield curve is going to become steeper and steeper. So I could see a scenario of the Federal Reserve easing shortly. But at the same time, I think the 10-year is going to be locked in this zone where it's been trading right now. And we'll see how this plays out. In all my scenarios, too, by the way, the yield curve is going to get steeper, not flatter. Remember, we've been living in a world where the yield curve has been inverted for so long, which harms, savers, benefits capital because the long rates were at lower rates. If we have a normalized yield curve, borrowers, savers are not going to get that benefit, but borrowers are going to get more harmed. So it has all these implications in our society.